Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel at the rate Accounting Buddy NB. In today's lesson, in the series of provision and reserves, we will focus on reserves, an essential component of financial planning and business stability. We will start with the definition and significance of reserves and then look at the classification of reserves into capital reserves, revenue reserves, and special reserves. Then we will explore the applications and accounting treatment of reserves, showing how business strategically use reserves. Finally, we highlight the distinction between the reserves and provisions, explaining their difference in purpose, accounting treatment, and reporting, which is crucial for accurate financial statements. Therefore, sit back, relax, and watch the full video.
Let us now learn the term reserve. Reserve is the amount set aside out of the profits for a specific purpose or to strengthen the financial position of the business. Reserve is an appropriation of profits or accumulated profits to strengthen the financial position of the business to meet a liability as and when it arises. Reserves are not set aside to meet any existing liability or depreciation in the value of the assets, but it is set aside to meet the known or unknown contingencies that may arise in the future. The amount of reserve when invested in outside securities, the reserve is termed as reserve fund. But when specific investment is not made, it is treated as a reserve. General reserve, workman compensation reserve, and investment fluctuation reserve, being appropriation of profit, are not shown in the profit and loss account but are shown in the profit and loss appropriation account. In this slide, we will learn the importance of reserves for a business. Reserves represents the portion of the profits that a business retains rather than distributing as dividends. They play a crucial role in strengthening the financial stability and long-term growth of an organization. Reserves provide financial stability and strength to a business. Reserves provide a financial cushion against future uncertainties such as losses, economic downturn, or emergencies. They enhance the firm's ability to withstand shocks and maintain operations smoothly. Reserves also support business expansion and growth. Reserve serves as an internal source of finance for expansion, modernization, or diversification without relying on external borrowing, thus reducing the dependency on debts. Reserves help dividend equalization. Business profits may fluctuate year to year. Reserves help maintain a steady dividend policy by allowing companies to pay dividends even in lean years. Reserves also support replacement of assets. Over time, assets depreciate or become obsolete. Specific reserves such as replacement reserve or capital reserve can be used to replace old assets, ensuring continued productivity. Reserves creation also helps businesses meet contingencies. Reserves provide a safeguard against the unforeseen liabilities, bad debts, legal disputes, or natural disasters, ensuring the company remains solvent. Healthy reserves also support in improving the credit worthiness of the business. A strong reserve position improves the company's credit rating, build investors' confidence, and enhance its ability to raise funds when needed. Let us now learn type of reserves. To have a better understanding of the nature and the purpose of reserves, reserves are generally classified into revenue reserves and capital reserves. Let us now learn more about revenue reserves. Revenue reserves are created out of the profits earned from the normal business operations. They are available for distribution as dividend or for reinvestment in the business. Revenue reserves can be divided into general reserve and specific reserve. General reserves is created without any specific purpose. It can be used for any purpose considered appropriate and to meet the future business contingencies or business expansion or strengthening the financial position of the business. For example, a company transfers $50,000 from profit to general reserve every year.
Then there are specific reserves. Such reserves are created by setting aside out of profits a reserve for a specific purpose and can be utilized only for that purpose. For example, workman compensation reserve is a specific reserve because it is maintained to pay compensation to the business staff. In this slide, let us learn more about capital reserve. Capital reserves arise from capital profits, that is, the profits not earned from regular operations. They are not available for dividend distribution but can be used for specific capital purposes like issuing bonus shares or writing off capital losses. Capital reserve is created from profit on sale of fixed assets, profit on revaluation of assets, premium on issue of shares or debentures, profit on redemption of debentures, profit prior to incorporation, profit on forfeiture of shares. All capital profits should therefore be regarded as capital reserves. In this slide, we will learn about the difference between revenue reserve and capital reserve. First basis of difference is the source. Revenue reserve is created out of business or revenue profits, while capital reserve is created out of the capital profits. Next basis of difference is from their usage point of view. Revenue reserve can be used for distribution of dividends without any precondition, while capital reserve generally is not available for dividend distribution. Another basis of difference is related to the purpose for which these reserves are created. Revenue reserve is created for strengthening the financial position and meeting the unforeseen contingencies or specific purpose, while capital reserve is created for meeting capital losses or to be used for purposes specified for which they are created. Let us understand the nature of reserves. Reserves are an appropriation of business profits and they belong to the owners of the business, just like capital of the business. Reserves reduce the profits of the business which is available for dividend distribution. That is, it reduces the distributable profits. Funds equivalent to reserves created can be invested in outside of the business securities. Reserves are shown on the liability side of the balance sheet and are grouped under shareholders or owners' equity. It is very important to understand the difference between reserve and provision. First difference lies in the meaning. Reserve is an amount set aside out of the profits to strengthen the financial position or meet future contingencies, whereas provision is an amount set aside to cover a known liability or anticipated loss, the amount of which cannot be previously determined. Next basis of difference is the purpose for which they are created. Reserve is created to meet the unknown future needs or for business expansion, while provision is created to meet known liabilities or specific losses. Another basis of difference is that of their nature. Reserve is an appropriation of profit, while provision is a charge against profit. Another basis of difference is their necessity. Reserves creation is optional and depends on management policy, while the provision creation is compulsory as per accounting principle and prudence. Effect on profit is another basis of difference. Reserve reduces distributable profits, while provision reduces net profit of the business. The presentation of both is also different. Reserve is shown under reserve and surpluses in equity section on the liability side, while the provision is shown as liability or deducted from the related asset. Reserve is created out of the profits as a matter of prudence and for legal compliance, while provision is made because of prudence accounting principle. Example of reserve are general reserve, capital reserve, debenture redemption reserve, while examples for provision are provision for bad debts, provision for depreciation, and provision for taxation. Let us discuss an illustration which of the following should be charged against profit and which should be an appropriation of profit. And they are provision for doubtful debts, provision for depreciation, and general reserves. Now let us discuss them one by one. Provision for doubtful debts is a charge against profit. Provision for depreciation is also a charge against profit. And the general reserve is an appropriation of profit. In this section, we will cover very short answer type questions. Question number 7 is, what is meant by provision? And the answer is, provision is an amount set aside by charging it in the profit and loss account to provide for a known liability, the amount of which cannot be determined with accuracy. Question number 8 is, give two examples of provision. And the answer is provision for depreciation and provision for repairs. Question number 9 is, what is a reserve? And the answer is, it is an amount set aside out of the profits to strengthen the financial position. Question number 10 is provision a charge or appropriation of profit? And the answer is, it is a charge against profits. Question number 11 is reserve a charge or appropriation of profit? And the answer is, it is an appropriation of profit. Question number 12 is, can provision be made without profits? And the answer is, yes, it is required to be made irrespective of the fact whether the business is making profits or loss. Question number 13 is, can reserve be created without profit? And the answer is, no, reserves are created only when there is a profit. Question number 14, does provision reduce profit? And the answer is, yes, provision is a charge to the profit and loss account. Thus, it reduces the profit of the business. Question number 15, does reserve reduce profit? And the answer is, no, reserve is created from the profit. Question number 16, give one example of reserve. And the answer is general reserve or capital reserve. Question number 17 is, reserves are shown on which side of the balance sheet? And the answer is, reserves are shown on the liability side of the balance sheet. Question number 18 is, out of provision and reserves, which appears on the liability side of the balance sheet? And the answer is, both provision and reserve appear on the liability side of the balance sheet. Question number 19, provision is made for what kind of liability? And the answer is, known liability of uncertain amount. Question number 20, reserve is made for what purpose? And the answer is, to meet future contingencies or strengthen financial position. Question number 21 is provision mandatory or optional? And the answer is, creating provision is mandatory so that the financials reflect correct profitability and financial position. In my next lesson on 21st March 2026, we will focus on practical questions from the chapter Provisions and Reserves. This session does not cover theory, as the objective here is to strengthen your understanding through application and quick concept checks. We will begin with high skill questions which requires a deeper understanding of the concepts. After that, we will move to very short answer questions designed to test your clarity on the topic provisions and reserves. We will also cover true or false and fill in the blank questions and answers to test your understanding of the topic. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share and like my YouTube channel @Accounting Buddy NB. Thank you and goodbye for now.